All right, welcome everyone at the webinar about startup funding, especially about how to look beyond your first funding round regarding the next funding rounds. We have some speakers that you already saw on the lineup, of course, who will give some more insights. We have it from the perspective of EY and the experience that we had already with startups and scale-ups. We have it from a legal perspective with our colleague Ruben Schoenmakers. And we also have some VCs invited here. Sebastian de Brouwer from Balderton Capital, and then Paris Soy from Aviate Ventures in San Francisco. The agenda for today looks like this. We will first have a little introduction, and then I will give some more information about how we are approaching startups and scale-ups and helping them by attracting the right funding, but also some insights by a little research that my colleagues and I conducted, and see what some scale-ups who already raised some funding rounds have to say about what to do, what not to do, where to look at, and how they experienced their journey of acquiring more funding rounds. Then it's Ruben who will talk about the legal perspectives, term sheets, who is experienced in raising funding for startups and scale-ups. Then we have the two VCs who will give a little bit more insights on how the European market might be different than the American market, for example, and how they look at things like valuation, also the term sheets, and how they approach startups and scale-ups that they want to possibly invest in. And in the end, we will have a Q&A where you can start asking questions already during the presentation if you want, in the Q&A window that you will see pop up. And then in the end, I will go through some of the questions and try to answer them or myself or with one of the speakers, of course. So I'm totally ready for it, hoping the same from you, and then we can start with the webinar. So first, a little word about myself. I'm a startup funding expert now at EY The Factory, the innovation team of EY, but I also have an experience in startups and scale-ups. I used to work for a Belgian technology company called Hoppler, where we also attracted some different sources of funding, starting from some decent grants, crowdfunding, to corporate venturing, to bank loans, to, in the end, the Series A round. For those who know Hoppler, also a few weeks ago, they were in the news again with the next 2 million round. So also there, we really had to look at how to structure all those different types of funding to make sure that you have the most optimized leverage on all the different sources. Then I also went to the US for a little while at a lot of companies with the ecosystem of VCs and technology companies in general. And after that, I joined the team of EY, The Factory, where we are then also helping startups and scale-ups to help attract the right funding and make sure that they are also having the most optimal financing mix. A little more about that is in the next slides. And why is it that we are focusing so much on helping those startups, scale-ups to get the right funding? Well, because of these numbers. Whatever list you can find on the internet, a lack of funds, it's mostly in the top 3 of reasons why startups can fail. Here you see some of the other lists. Typical others are, of course, no market need or not a right team, but you will see running out of cash is one of the main reasons that startups are failing. So why is external capital so important? Why can it help your startup so much? Of course, there is bootstrapping, which means that you are providing your own funds by getting customers and making sure that you're having enough revenue. But there's a big difference, of course, when you have only 200K to start your business or to grow your business, or when you have way bigger amounts. Of course, I think those pictures are a good representation of the starting point of a startup or a scale-up and what the difference can be. That's why a funding journey is so important, and how we look at it is actually in 5 steps. 5 steps which you really need to go through to make sure that you really have a funding journey and are not just a founder who is approaching an investor trying to get some money but not with a real strategy behind it or the real goal for the future. So that's why we think it's quite important to have the right funding journey. And it might be that you are not able to at every step of that journey yourself, that you are not able to do it all yourself. That's of course why parties like us and other consultants can come in. But let's first go through all those steps and why we think they are so important. Also, that funding journey might take up 3 to 6 months, depending on how mature you already are and how experienced you are with raising those funds. But you have to keep in mind that it's not an overnighter to get the right funds for your startup. I already talked about different sources of funding. Remember, for example, the example of Hopler, where I was talking about earlier, where we had a lot of different sources of funding, starting from subsidies and a little bit of own money, the friends, fools, and families, like we call it, crowdfunding, also corporate venturing. You have all those different sources already, and it is important to make sure that you fit them rightly in, that you can leverage those. Quick example on that. For example, the typical subsidies from VLAIO, mostly they only cover 45% of your whole project. So if you say to them, okay, we want to have 200,000 euros, or we think we need for this project 200,000 euros, then they will consider it and they will say, okay, if you think you need 200,000 euros, we will give you 45% of that if they believe in you, and the other 55% you have to look for someone else to invest that money, or maybe your own money in the beginning. If you're not leveraging that in the right way, what we see often happening is that founders put first their own money already in it, then they run out of money, and then they realize, oh, look, a subsidy is maybe a nice opportunity, and only then they bump into that situation where they see, oof, they are only covering 45% of the whole amount of the project. So now I have to look for another 55%, although they could have used their first own money for it, for example, if they were from the beginning looking at that right funding mix. So important sources are, make sure that you optimize them in the right way so you can leverage them on each other. And instead of only raising a certain amount of money, maybe raise double or a little bit more, just because by taking the right and the most optimal steps. That's what I mean with this piece of the puzzle. Now, those different steps, it all starts with the optimization, as I already said. What is the best funding option for my startup? Might be starting with subsidies, might also be crowdfunding, might be whatever you think is necessary. Also look into how much you really need. You don't want to have not to raise too much in the beginning for your startup. If you would be able to do that, it would be nice, because then you think, okay, they believe in me, but then you might not have the best valuation, for example. Also make sure that there's a nice roadmap. You really know wherefore you need those funds, because investors don't like it to hear that you're approaching them as a founder and say, okay, I need this amount of money to grow. And then they will ask, what do you mean by grow? Is it growth in users? Is it growth in revenue? Is it growth in impact? Is it growth in whatever? So make sure that you're having a roadmap and really knowing what you wanted to do with the funds that you're raising. As we already discussed, there are plenty of funding sources here, and the leveraging of the right combination is very important. Then the preparation comes in. Basic preparations like knowing how to pitch your project, your startup, or your funding roadmap to a VC or an investor. Making sure that you're investor ready, that there is a deal room, for example, that if there are questions from potential investors, that you know how to answer them, that you know where your numbers are, that you know where, for example, revenue is already coming from, or if there's no revenue yet, that you know where you will get your revenue from. And then also term sheets, an important one which we will discuss later here, talking about having the right deal with your investors. There's a basic preparation mostly. Then there is the tailored preparation. Again, the pitching. If you are pitching towards, for example, the two VC speakers here in the call, they might need a different pitch. A American VC fund is a little bit different than a European VC fund, so they also require a different pitch. That's why it's important to make sure that they are adjusted, the pitches, and also the person who is pitching. Mostly investors want to have a founder there. If you know that your founder is, for example, a super techie guy who's maybe not the most communicative, then you might look for someone else in the team where you know that he's good in bringing out the story, making sure that he's making good connections with those investors. So make sure that you're also choosing the right person of your team. Those kind of pitches. Another thing where we mostly help with is making sure that the business case is strong enough, because you might come up with great ideas, but you also, especially what investors wanted to see, is also a strong business case behind it. Also making sure that all those numbers that you put in there and projections are validated. So we can then mostly help with financials and evaluations, also the legal part of it, do a little market research, competitor analysis. That's typically something where we as a UI also help for, because we have plenty of people all over the world already doing consulting in a lot of other markets and a lot of other places in the world. So then we can apply all those insights into startup or scale-up projects that we have. What is a typical next step after the optimization and the preparation is really connecting with the investor. As I said already, it is important to have a right connection there, and it might be that your perfect investor is not a perfect investor from your colleague startup, or for a startup who's doing the same but in a different geographical area. So it is important to make sure that you have the right connections there, that you know who could be the perfect investor for you. And it also might depend on the timing. Maybe your perfect investor now is not the same as an investor for your second round or third round. So that's also something typically where we try to help with, is identifying those investors based on the stage or the sector you're in, the ticket size, region. Again, making sure that your pitch is adjusted to that. And then also fine-tuning the specific needs or interests of the investor, because that's something where we mostly have insights in, is also the type and specifics of a certain fund or subsidies, for example, or a business angel. We know what their sweet spot is. And so it's sometimes easy for us to say, okay, this can be a match, or this will never be a match. And also making sure at the evaluation, we already discussed or touched on that shortly. And also the follow-up, because connecting with investors is one, but it's a long-term relationship. Sometimes we make the analogy with going on a date. Going on a date might be nice in the beginning, but if you want to have a strong relationship, and if you really want to marry an investor, speaking at analogy again, then you have to make sure that all things are worked out well. Although a first date might be wonderful, you also want to make sure that after 6 months and maybe after 6 years, you're still in a good relationship with them. What we offer for that is then we have a lot of networking events. Back in the days, physically, we still remember. Now a lot of them are virtual, of course. Then we also are co-aligning, making sure that what you think is important for your vision and strategy can be translated into some insights that we have from investors. And then also making sure that you're connected in the right way, and that we just not put all startups to all investors that we know, but having a tailored approach for that. Then the negotiation part, that's where Ruben, the next speaker, also will talk about all the legal stuff, the valuation, making sure that you are negotiating the right stuff in your term sheets, but also helping a little bit the business modeling, those kind of things who are important in this part when you are already talking with a potential investor. And then you have the closing. Like I said already, it's not because of the fact that money is on the bank that your relationship with the investor closes. Those are typical steps which are important to go through what we call the funding journey. Some of you might have already a lot of experience with that. Others might not have that much experience in it, but they know that there are plenty of people who do have experience. So don't hesitate to reach out for help on that. A little bit more about EY itself. I guess a lot of you know already, EY is a Big Four company. But what is typically on my team is we can help with starting the business. It's a typical startup or scale-up service offering that we are doing. Not everyone is aware of a Big Four like EY helping also in that phase. It's typically something that my team is doing. And then optimizing also your business, things we discussed already before for the funding, but not only on funding, it also be around internationalization or shareholders that you want to bring in or put out again, those kind of things. The funding, most important part, that is where this whole webinar is also going about. But then also going international, if you want to scale, a typical thing that happens with mostly technology startups who are having their first or maybe their second or third round already, they want to use partly funds to go international. Also there it's important to have a partner who knows where he's talking about. If you go to the Netherlands from Belgium as a first internationalization step, it's mostly a typical one. But if you suddenly want to go to China or to the US, then things might be way more difficult, not only from a legal perspective, but also from a cultural perspective, also from a tax perspective, also from a funding perspective. So that's important also there, I think, to have the right partner. And even in the end, if that would be the goal, it's not always the case, of course, but it could be the goal to sell your business one day. Also there, it's important to already start thinking about that early in the process, and then you can work towards that goal. If your goal is not selling the business, but for example, going for the biggest impact or growing until international or whatever the goal is there, make sure that you also keep that in mind already from the beginning for a strategy. And also funding wise, it will be quite important to know where you want to go to in the end, because those will, you have to make sure that all the steps in the process are going towards that certain goal. Of course, it's not always easy in the beginning to say, okay, in 5 or 10 years, I want to be there, but at least have an indication there and make a plan. We can always adjust the plan along the road, of course, if some things might change later on. Those are the typical service lines that we have at EY, of course, but as I said already before, my team is converting all those expertise that there is already there for years within the company. We are converting that and translating into startup and scale-up services to make sure that they are able, that startups are keep relevant for the company, and also our company keeps relevant for the startup. So that's what our team is about. Another thing we already touched upon is the international aspect. So there again, we are an organization with more than 700 office locations in more than 150 countries. So there is a nice network within the company, and it is for us not that difficult to activate the network, of course. So it's also when it comes to funding, might be an important strategy to follow. So that was a little bit about me and about the company. We also did a little research for what could be some insights of startups and scale-ups. They came up with a lot of nice answers, and we tried to bundle them and try to look for things that were the same in the whole process where those different startups and scale-ups went through. And that's something that I wanted to share with you guys now as well. So some of the companies you see here, Hopler, Settlement, Deliveract, but there are some others as well. Some things that we saw coming back, for example, if you were asking them, like, what would you do differently in structuring your different funding rounds? If you look back to all the funding rounds you have already did, what would you do differently? A thing that came up was one dedicated person working on the funding. Because sometimes it is not easy as a scale-up. You have so many things to do, and you want to focus actually on your core business. And raising funding is mostly your core business. So then you see that there are people who are putting all the team on raising the funding, and they have to work all a little bit on also helping with the funding. But it's difficult. You can look for help outside of your organization, which gives you the opportunity to keep focusing on your business. And if not, make sure that there's a good your CFO, for example, or someone dedicated working on the funding process. So you, as a founder, can really focus on what's important, aiming your business. Another thing that came up was getting to know the cultural differences between all the VCs in different continents, but even when it's not coming to only geographically regions, so not only different continents, but even different VCs itself. Like for the Belgian viewers here, there's a big difference between a Frank Mane, for example, and a Jurgen Ingels. So if you don't know those type of differences before, then it might be difficult, or you might lose a lot of time by researching it yourself and making in the beginning sometimes wrong decisions or wrong assumptions about it. Also, for those who already have an advisory board or advisors around your company, we heard a lot that sometimes they didn't took enough advantage of it, that they were so busy with raising those funds that they didn't consult their own advisory board or advisors enough. So that was also a typical one that came up. And also, fourth one here, are building relationships with VCs before looking for funding. It's a very important one also, because it gives you already an idea of what the investor is, but also the investor already knows you, and he is also already able to draw a picture of your company, and might follow you, might see you in the press or whatever, and then you're building up a relationship. If you only get in touch with an investor only when you need the money, but then also your negotiation position is a little different, of course. And that's, by the way, a general lesson. Also, start to look for funding at the moment when you don't need it, because it makes your negotiation perspective and negotiation position way more stronger than when you are there with back against the wall and really needed the money as soon as possible. You will realize and see that VCs and other investors are feeling that, and then they might use that when it comes to discussions about the valuation and stuff like that. Then if we ask the okay, what would you do differently? It is not giving away too much equity too early, a typical one, and that's again a valuation discussion. Also, talking about liquidation preferences, that's something that also Ruben and Sebastian will cover later on. If you're not familiar with that jargon, they will explain a little bit later on, but easily said here, it might make things complex for the next round. So make sure in the beginning that you have, or try to have, a nice and clean cap table, the right phases in your term sheets are there already. Don't make it too complex, because it will only get more complex for the next funding round. Then another thing that came up was using the NDAs. There are different views on that in the ecosystem. Not everyone is a big fan of NDAs, especially not when it's a early stage, but sometimes you just can't go without them. But it's a thing of trust also. Not every investor likes it when there's a startup pitching their project, or before they want to pitch a project, they are coming already with very complex NDAs, and it's not a good start, mostly because then the investor thinks like, okay, if you don't trust me not now in this moment of the process already, what will it be later on? So it is always a little balance that you have to look out for, but still we realize that there are some startup scale-ups really concerned about NDA, so that's why we put it in here as well. Fourth thing, and I think that's the main message of my previous slides, having a clear investor journey. It's not like only for your customers where you have a customer journey, but also for your investors. But that's what I already discussed in the previous slides. Now, other questions that you ask them: who is your ideal investor? You can be sure about that. One with the right connections in your or your complementary sector. And that's then the difference between smart money or just financial money. Most of startups or scale-ups really want to have the smart money. If you're giving away already that many shares, for example, to a VC one of the following rounds, you also want to have some nice network or a nice advisor from it, and not only having the money and try to get a nice return after some years. It's also a big help if they can introduce you to their network, which is mostly there already if they're active in your sector or in sectors. And then also someone who can be involved in the company and is really passionate about the project that you're doing. Also there, it is a balance, of course, because not every founder wants an investor who also gets involved on every daily operation. But still, it is nice that you have an investor who really is following you and is involved in the project as well. Some other quick tips and tricks. Also talking about funding. Sometimes you hear it talking to founders like, oh, but you raised funding here, we raised funding there. Realize that just raising funding is not the goal. You want to have a clear impact, hopefully, and raising funding is just a way to get there. But make sure that just raising funding because it looks good on your LinkedIn or it's nice to write an article about is not the right goal. Also, don't raise too much money too quickly. Again, that's a valuation thing. Also, make sure that you use the funds effectively. That's related to what we said in the slides earlier, to have a nice roadmap to make sure what funds shall we need for what projections that we have made or what impact that we want to have, what business model that we want to implement. Because otherwise you might track some money and think, okay, nice, I got a big bag of cash now, but what shall I do with it? Let's see. That's mostly not the right strategy. So make sure that you use those funds efficiently. Another tip and trick that we got was making sure that your management is already building relationships with investors. A little bit related to previous questions, saying try to build relationships already before you start raising funding. Again, the NDAs, we discussed about that already. Not everyone likes it, but for some it is important. And also timing. You don't want to raise too much money too early, but of course you also don't want to be too late because I'll picture with that. If you are really in a financial need, as you saw on the first slide, it's one of the main killers of a startup scale-up idea. So that's my parts of this webinar. So I'm very happy to give the stage now to Ruben. He will talk about legal perspectives on it, and we worked already together a lot on some projects. So Ruben, the stage is now.
Thank you very much, Jelle, and good afternoon, everybody. I saw a couple familiar names with the participants, Diego, Maurits, Jules. Thank you guys for joining. All the other guys and girls who doesn't know me. My name is Ruben Schoenmakers, and I'm a lawyer working within EY Law. EY Law is an independent law firm associated with EY. And within EY Belgium, I'm highly involved in the EY Innovation Project, which is basically a platform for startup and scale-ups, where we, among others, organize webinars, such as the one we are having today. But we also do workshops and matching events, and also like individual expert sessions, one-on-ones. So I invite everybody, in case you would like to make use of that, feel free to reach out on LinkedIn or just send me an email, and we can exchange thoughts on a legal topic related to staged funding, where you want to have a conversation on. My expertise lies in the legal aspects of staged funding, and besides that, I developed also quite some experience in the last 5 years in mature merger and acquisitions. So hopefully, if you've done well and you, at a certain point, you work to a sale, then you are going into that trajectory, but it's a different dynamic than the one you have with an investment. Today, I will try to inform you a bit about the process and also give you some information, tips and tricks on an investment track from a legal point of view. I recycled a couple of slides, and I will not go too much in depth. Let me see, Jelle, if I can. Yeah, voila. I will skip a lot that is on my slides because a lot of that we deal with more in depth in a workshop where we talk, for instance, about how to negotiate a term sheet from the perspective of a founder, or how to calculate a cap table, taking into account convertibles and floors and caps. So that is, we need a bit more time, and I only have 15 minutes to touch upon a couple of legal elements. So the question I have is, think further than your first round. I need to deal with that topic, and I will try to refer to the two most recent investment rounds where I acted as lead counsel. One of them was the Beerselect investment round. That is a startup Ghent-based, where 2 years ago we assisted in a seed round of €200,000 with 10 business angels. And a couple of months ago, we closed a more mature investment round of approximately 6 million. And that's because they've done pretty well. But it's a different dynamics between a friends, family, fools / business angel round and a professional round. I will not use the terms pre-seed, seed, Series A, but I will only make a simple distinction between a professional round where you deal with a professional investor and a round that is less professional. With that, I mean like the type of people and the amount that you raise is from a different category. So I would say, as what I see in Flemish fundraising, I would say below €400,000, you often see friends, family, fools, business angels, and there it is often requested from the founders team to put the term sheet on the table, where if you go into a more professional round, which can be also, of course, 400,000, but typically a bit more, then if it is a professional investor, he will put the term sheet on the table. Voila, that's the distinction I make, and I do that because I will refer to the two different dynamics in professional round with a mature VC fund, and then the first one is a business angel round with 10 business angels that put a little bit of money on the table. Again, in Flanders, mostly driven because they have a tax shelter, so they have a tax incentive, and then they invest into the company only partially because they have an affiniteit with the founders and the product, and of course because they also believe in it, but also because they have that tax shelter point. So voila, what you see is a potential timeline. How does that go? You first start with the conversation. You do your homework, like Jelle explained. You have some materials that you prepared, maybe a pitch deck, maybe already a business plan. And once you are in contact with a potential investor, which can be, again, a couple of business angel or an investment manager of a VC fund, once there is a mutual interest, the next step would be a term sheet. And I already said that if you have that friends, family, fools, business angel round, it's most often that the founders will draft the term sheet and send it to the interested parties. I'm always saying the best term sheet is no term sheet, because the term sheet, at least for the founder, is mostly in favor of the investor. The longer the term sheet, I also included in the slides, I included an example, I'll show you in a bit. The most principles that are in there, and in the second step, it will be translated into the subscription agreement and the shareholders agreement. It's in favor of the investor. So once you've negotiated the term sheet and you signed it, after that, also a couple of elements still need to be done. For instance, some due diligence, you need to negotiate and draft the more definitive agreements, the SSA, which is the subscription and shareholders agreement, a bit of terminology. It could be that some IP still needs to be transferred, or even that the company still needs to be incorporated. The final stop is the notary public, and there is the closing and the fund flow. What is important before you start in this process is that the co-founders are aligned. I think that is very much important that you do that exercise. And what do you need to consider? Who do you consider a co-founder, and what do you understand of the commitments that a co-founder needs to be doing? Assume, for instance, that Jelle and myself have a startup and we both have 50% of the shares. It could be that the agreement from the start is that we both push the startup and we do all the work in it. That 100% of our time is the commitment to see how we can grow and scale. But assume that like in 6 months, Jelle got an offer to work, for instance, in the States, a beautiful position with a nice company, and he is tempted to take that. What happens then? Can Jelle still be the owner of his 50%, or is there a consequence? It is rather unhealthy that you have somebody as Jelle who is not part anymore of the startup and still holds 50%. So he's not a working shareholder anymore, but he still has 50%. So that is an exercise, and I call this co-founder alignment, that is very much advised that you do. So think of the consequences. They can be good. My example of Jelle that has a beautiful job opportunity in the States, that's a good example, but it can also be bad. That I don't want to play my role anymore as I have committed in the beginning. And what is the consequence? Does the company has a call option on all my shares or the other founders of the shares? And for what price? Is that for a symbolic euro? Is that for a discount on the market price? And what about the tax element? Because if you buy your shares back for a symbolic euro, but the company is already valued at $1 or $2 million, then you also have an issue. So this is all stuff you need to take in consideration. It's covered in Good Leaver, Bad Leaver. Probably heard about it. But my advice is that you do that exercise, and good practice would be that you include that in like a starters agreement before you start with your fundraising, even your business angel fundraising, or after that in corporate investment rounds or VC investment rounds. Go to the next slide. Let me see, 7 minutes left. So how will an investor typically protect his investment? Well, he will make arrangements with you about the financing. He can, for instance, invest in different tranches, and he will only give you the second tranche if you have reached certain milestones. That can be, for instance, that he already commits himself today that he will invest 1 million. However, he will only pay up 500,000 now, and in 6 months, he will pay the second tranche of 500,000 euro if you reach certain milestones. So that is a way for him to protect his investment. He's not doing it at once, but he's doing it in different tranches. I'll go back one slide. He can also make arrangements about the use of the proceeds. How can you use the investment money? Often that's according to the business plan. It always jumps, Jelle, but I'm still one slide behind. No. Let me quickly go back one more. You will make arrangements about financial reporting. Do you have to report on a monthly basis, on a quarterly basis, and in what format? What is the information that he wants? The monthly sale, the forecast, the amount of employees. These are all typically arrangements that you will make on a principal basis in the term sheet, and later on it will be translated into your shareholders or subscription agreement. Also very common that an investor will have preferential shares. The name of the shares doesn't say anything. The rights attached to it does say a lot. So I advise you to do the exercise properly and always look which type of shares are attached to preferential shares. if you would see in a business angel, friends, family, fools investment round, a liquidation preference or anti-dilution provisions, or extensive voting rights and exit rights, I would say that is very much uncommon. However, if you are seeing that in a more mature VC investment round, that is more common. But there are different modalities about those concepts that you really have to take into considerations. Take, for instance, a liquidation preference. Often that is drafted that in case of an exit of the company, which can be an IPO or a sale, the investor will receive his investment amount back at a multiple. And a common multiple, and I think the next speaker will also shed some light on that, is a multiple 1. And that is downside protection of his investment. But what we've also seen already is that they try to include like a yearly interest on the investment amount, take for instance 20% of $1 million, and without being capped. If you are in a business, and in the beer select case that was the case, that was unacceptable because they now had like a decent valuation already because they did quite well. But in a couple of years, they will be more into the multiple SME valuation than in the future DCF valuations, which are typically higher. So that was a concern that the yearly return, the yearly percentage on the included in the liquidation preference would go up too high without being capped. So that was unacceptable. In the other round, the business angel round, with puzzle in the back, that's the other one we closed with 10 angels who each put 25,000 euro on the table for 30%. There was a company that was not yet established, and the founders themselves put a liquidation preference for it. Why? Because they also included a rather high valuation. And that is something that you should be aware of, that a high valuation often triggers a more aggressive liquidation preference or more aggressive anti-dilution provision. If the valuation is too far from what an investor was initially willing to go with you, then he might be more aggressive in liquidation preference and anti-dilution. Let's see, 2 minutes left. I included a term sheet in the slides. It's more for reference purposes so that you can have a look what's typically in there. A term sheet is like a document. It's mostly a piece of paper, 1, 2, 3, 4, 5 pages, where you only include the negotiation principles. And in a later phase, those principles are like further drafted in more detail in the shares and subscription agreement. I will go to my last slide, where I listed a couple of. Jelle, can you go one further? A couple of tips. Make sure the founders agree amongst themselves. That is very much important. If you are arguing or not agreeing, and you still have to negotiate with an investor, that's not the way to go. Choose your partner wisely. I think that is something Jelle touched upon. If you really have a long term and you do not want to be forced into an exit, some VCs, they are looking to an exit, so that's maybe not the right partner for you. Focus on the size on the cake rather than your piece of it, an obvious one. Next one is less obvious. The numbers of shares does not equal the rights. That's actually quite important because it doesn't mean that if you only have 25% as an investor, you can still have very favorable rights in terms of liquidation preference, voting rights, exit rights, whereby the value actually of your shares are worth more. Next one is a negotiation tip. Once agreed, even verbally, it's difficult to step back. Pick your battles, and the devil is in the detail. So once the final agreements are on the table, do your proper homework. Voila, that's it. Thank you, guys.
All right, thank you very much, Ruben. Then we will go on with the next speaker, Sebastiaan de Brouwer from Ballerton Capital. So do you want to take over the screen as well, Sebastiaan, or do you want to share your own slides now? I'm still muted at the moment.
I'm assuming you can't see my screen just yet. There we go. You should be seeing my screen now.
Exactly. Thank you.
Super. Great. Yes, so happy to be here today and give you a little bit of context coming out of, I guess, where we are coming from as a VC. I'll give you a little bit of background on myself, on who we are as a fund and how funds like us think in Europe. So you have some context, and I'll pick up on a couple of things that we've talked about with regards to terms, negotiating and orchestrating around. I probably won't be able to cover everything in detail, but I'm extremely happy to also pick up offline on any questions that remain. In terms of me, as a little bit of context, I've been a VC for about a year now. Started my career as a consultant and then worked on scaling a micromobility company and ultimately worked on both fundraising and an exit. So I guess I've seen both sides of that coin. And the fair caveat I can give is that sometimes it looks better in a TechCrunch article than it is in reality. Four things I wanted to cover today. I think one is a little bit who we are at Balderton. I'll try to go through that relatively quickly, but I think it'd be helpful to get a feel for where we position ourselves. A little bit about how we think about investments, so that as you're a founder approaching venture capital investors, you can also kind of put yourself in the shoes, especially of an early stage investor, and understand a little bit what motivates and drives those decisions. A little bit how we look at different stages, and I think the main question here was to give a little bit of an indication on the traction we look for. So I've put together a bit of a matrix to walk you through. And then finally, what the process normally looks like on our end, and what you kind of look at for provisions. In terms of us as a fund, our fundamental thesis is actually relatively independent from sector. It really is around Europe, and Europe being a great breeding ground for large technology companies. We've been operating on this thesis for a little bit over 20 years. Originally, we were the European team of Benchmark Capital, which is a Silicon Valley fund in London. And then we've been independently investing for about 20 years. Our 7 funds in, and have backed about 200 plus companies. As of this year, we will be having a dual strategy where we are investing at early stage, which means Series A, sort of $5 to $15 million rounds, and later stage, what we call growth, which is Series B and beyond, and our slightly larger tickets. That's a little bit around Balderton. In terms of how we think about investments, what's important, I guess, to understand if you're an entrepreneur looking at VC funding is to understand that there's a different logic in how investments are made. If you make a private investments, which I, for example, have also made a number, and I know many people in the entrepreneurial ecosystem do, you are more looking to be part, I think, of a journey early on where you're very much relying on people and you expect that something interesting will come out of it. With venture capital, it's a little bit different in the sense that the idea in the asset class is that there's a distribution whereby there is sort of an over-indexing of great outcomes here, which are really huge outcomes, where the company becomes worth 10, 100, 1,000 times more than it was at the time that you invested. And a longer tail of companies that are good exits, but are not necessarily huge exits. And so the idea is that instead of optimizing for the average outcome, which is what you would do here, and which is, for example, what your public portfolio of stocks might look like, you try to optimize for those kind of extremes, those 10, 100x. And that's kind of in terms of the baseball analogy, which I think is really helpful. It's really just trying to swing for the fences and get home runs and be okay with missing 10 balls if you strike out one of them. What that means for us is that essentially as a VC, we are looking for either extremely large markets where even taking a moderate stake can make you a very valuable company, or an ability to take maybe a smaller market, but really get a dominant market share, and therefore again sort of get the kinds of revenues and multiples that make sense. There's a lot of detail to how we think about this, but I think by and large, those are sort of the two very big categories that people might think of. What that also means is that we, when looking at investments, try to still find these early proof points. I'll get to this in a second, but we sort of invest a little bit beyond you having the idea and starting to work on it, but well before you kind of having a large, sizable, scalable, somewhat predictable business. And so the kind of things we look for is, the disruptiveness of the solution, and I guess how strongly it addresses a particular problem, how defensible what you build can be. And there's various ways to think about this. Whether eventually it can be an attractive business. I think there's a high tolerance for burning amounts of cash early on as you grow and find out a business model, but eventually finding a way to get unit economics that makes sense, which means that every additional sale or every additional user ends up being cash generative. And then whether the company is scalable, which, for example, might be around, if you're developing a solution for large enterprises, is it always bespoke tailored work, or is it actually a product that largely can be rolled out and scaled across companies? That's probably how we think about it. I think the most important thing to bear in mind here is when you're talking to a venture capital fund, they're very much asking themselves the question whether you can be a 10 or 100x outcome that they can have a meaningful stake in. And sort of the whole process is very much designed around that. Now, in terms of when to raise funding, which is sort of the second question, this might be a little bit of a UK-centric approach, but I will give it to you and then happy to be challenged on it. If you sort of broadly think about the development of a company, coming up with an idea is here and is very much, two people in a garage building something. Starting to build it is here. We will tend to invest around early stage. So here you'll mostly have your friends, family, fool rounds. Here you might have some very early stage investors or angels. This is usually the territory where you will definitely start encountering venture capital because it's the point in time when you need cash to fuel the beginning of growth, expansion, and ultimately positive cash flow. And so that's where we invest. We do sort of, like I said, 5 to 20 million early stage tickets. What that means in terms of a business is roughly the following. And again, with a big caveat, I've sort of sketched this out on basis of the napkin, which I think different people will definitely give you different answers here. But I think if you broadly think about what shows initial traction, and again, sort of thinking at seed is the point in time when you have a product that attracts customers, and Series A onwards is you have a business that you can start scaling. At seed for consumer, which is something that I look at a lot, we'll start looking at having an increasing share of daily or weekly or even monthly active users, depending on the application you have. That ballpark needs to be of a certain size. And I usually sort of think about 25 or so K users. Revenue depends a little bit. If you have something like a marketplace where you take a small cut, it makes sense to start seeing revenues that are sort of $250,000 and above. Obviously, if what you're doing is creating an audience to monetize it later, think of the typical social media model, that won't necessarily be as applicable. If you're going to a Series A, the most important thing with the consumer business is growth, is very much sort of strong month-on-month growth, is really seeing that kind of hockey stick curve. Or if that's not the case, recurring revenues, recurring users, an ability to kind of dictate the price that you're looking for. And again, sort of more in a monetization later type of model, it's basically 10xing the number of users that you might be having from a Series A. Obviously, for both of these, and particularly for consumer models, things can go very quickly. And so the time between this and this can be very limited. If you then look more at sort of traditional software solutions, it's probably more around showing that you have a product that has a fit, that people are willing to pay for it, and that you're able to start charging a real market price that is reflective of the ROI and the value, not necessarily what you might be charging your first customers. So for seed, and this would normally be too early for us here at Boulderton, but it's, you know, depending on account size, of course. If your accounts are 50K, then this is only one account, right? But it's having a number of accounts that you start having, that you've acquired, that you've rolled out, where you're charging. I think 10 to 50K is generally a healthy indicator. For Series A, it's probably more, once you've got a year's worth of cohort data, we're able to start seeing how your sales process works, how long your sales cycles are, what the cost is for you to acquire a user and to onboard a user and to serve a user. And usually we see that kind of maturity coming in around the 100, 150K mark. Again, sort of depending a little bit on whether you sell a software solution that costs 5K a year or 20K or 50K. But very much here, you know, starting to see that you have a sales engine, and essentially if we would put in more time and money with you to hire more salespeople, to get more engineers on board, to fill the top of your funnel more, that growth can kind of exponentially take off. Deep tech, I'll tell you a little bit less about because it's probably the area I'm least knowledgeable about. But in terms of seed, you know, it's really the idea that you have a unique team with defensible IP and ideally some application of the technology. If you're looking at Series A, usually it's no longer just a proof of concept. It's the idea that you might have a pilot that's running. You might have some commercial validation through letters of intent or ideally a paid pilot. Anything that kind of shows that the future sci-fi pipe dream you have is actually a real thing and is starting to work and attract customers. Again, this is sort of my rough thinking around this. I think every company is very different in this regard, but that's roughly how we look at things. What you do see in Europe is that there is more and more space that's opening up in between these two, where you get Series A style tickets for slightly less proof points, which is probably a very good thing. I think it's a maturing of the ecosystem and more capital going into it. So don't think that because you're not hitting, you know, 100K in MRR, that it's not worthwhile to go and engage investors. It may very well be. Looking at time, I think I'm roughly about halfway. In terms of the process of fundraising, some of this has been covered, so I'll walk you through it quite quickly. Specifically, this slide, I think you probably roughly know what it looks like these days, but it's a funnel where you kind of go from identifying investors to qualifying them to being diligenced and doing diligencing to actually getting an agreement on terms. There's lots of this online. I think the most important point that I want to make, especially if you look at a Series A, is there will always be investor interest in this kind of climate, because there's a lot of capital trying to be deployed. So don't necessarily let anyone else dictate your fundraising timeline. I think the fundraising timeline as a company is something you need to be quite mindful of. And pretty much, I guess, just like anything else where you might be in a sales process, you want to optimize it for when things are going your way, which means you have enough money left in the bank to be able to run the process for a couple of months, but also you're starting to hit the traction numbers that you want. Some of the bigger macro changes that you might need are in place, things like that. And so I think don't sort of fundraise. Look at the time when it works for you, get everything geared up, and then fundraise and get the process also closed off relatively quickly. In terms of the term sheet, this is the one bit that I wanted to touch on a little bit. It's often thought about as sort of the end result of a fundraising process. And in a sense it is, because it means someone's expressed interest and put that on paper. But first and foremost, it's not legally binding. It's not a final set of terms. And you still need to close out with one or more investors. So think about it in a sense as an early good proof point, something to work with. But not the end stage. I think the end stage of investment is quite obviously to get people to invest in your company, take shares, and wire over money to your bank account. In terms of a term sheet, broadly 2 areas to bear in mind. I'll briefly run through a number of them. Ultimately, it's always kind of a balance of the economics of how the business is valued and what happens in various scenarios and stages, and how the companies run and how much of that you put in the hands of the investors. We've very briefly covered liquidation preference, so I'm not going to go into a lot of detail, but to give you a rough indication, within Europe for Series A investments, Series B investments, seed investments, you should almost always look at a 1x liquidation preference. That is really the market standard. Anything kind of deviating from that would need a good explanation. If you look at a non-participating preference, which I can give a lot more detail on, but essentially it means that your investors only pass by the till once, not twice or more. In general, the one thing to say here is if you're looking at various term sheets with different valuations and investment amounts, in early stages, I would still optimize for liquidation preference if push comes to shove, because it can make a material impact on your outcome. I've briefly sketched that here. I'm not going to necessarily walk you through the entire mat. What you're sort of seeing is if you're getting a similar investment, but with a different liquidation preference, ultimately 1x participating liquidation preference will leave you a little bit worse off than non-participating. And that's because in a participating liquidation preference, the investor first gets their actual money that they put in back, and then still participates in whatever is left. So they kind of walk away with potentially significantly more. Whereas in a non-participating scenario, essentially the VC gets to decide between getting their proportional share or the share that they put in. And so it's a more straightforward calculation. The other warning here is that as you kind of extend certain investor privileges like liquidation preferences, it's something that you can only, once you put it on the table, you can't really take it off anymore. Most investors want to have similar rights in later rounds as investors had in previous rounds, at least, which means if you give too high a liquidation preference or participating liquidation preference early on in the process, it will hit you over and over and over again in the next rounds. And so this kind of dynamic will come back over and over again. The second one to cover briefly is anti-dilution preference. The way to think about this is like downside insurance. So in case you raise a round and then after that you need to raise a round at a lower valuation for whatever reason, you may not have hit milestones, you may have had to go back and change the way you go to market, you may have realized your initial product wasn't worthwhile, the overall economic climate might change and funding might be harder to get by, whatever the scenario. The main thing here, I think, is you will see two kinds of anti-dilution. You will usually see a form of anti-dilution, especially kind of from Series A onwards. But you'll either have something called weighted average or full ratchet. To simplify it, weighted average would mean that if you had raised at 8 million with the investor and then the next round is at 6 million, their downside coverage, the additional shares that you would have to issue them to cover for the downside, would be somewhere in between both, which means you wouldn't be, as a founder, the only one bearing the brunt of a lower valuation. If you have full ratchet, you essentially give them full upside insurance, which in this case means that you would give them significantly more shares to make sure that their value, the 4 million they put in, remains the same. So by and large, again, as you can see, sort of the full ratchet would make you lose more shares, as would a liquidation preference. The main way to broach this topic in discussion, by the way, is that you, both as an investor and a founder, must believe that the valuation you're putting on a company today is a fair valuation, independent kind of how market circumstances might change. And so that it is all right for an investor to potentially have some downside risk covered off, but not all of it, because at that point in time, all of the optionality sits with the investor, none of it sits with you, and that's not what partnership is about. The last thing is option pools and pay to play. I'll go through this relatively quickly and just give you my take on what I would do if I was a founder. I think option pool is really important. Very often founders actually underestimate this, but if you want to get key talent on board, you want to make sure you have enough of an option pool to give good initial and also bonus equity to well-performing employees. The big discussion here is whether you want to expand an option pool before the money comes in or after. As a founder, you want to ideally do it afterwards, because that means that all of the existing investors pay for it. For example, if you create a new 10% option pool, that's kind of 10% that goes away from everyone. If you do it before the round, it only comes out of your share, which again means you kind of lose, proportionally speaking, a lower percentage. Pay to play is something else, but essentially it means that as a founder, you ask an investor to do their pro rata for a certain number of rounds. If they don't do their pro rata, so in other words, if they don't invest in your next round, they're still shareholders. You can't fire them as shareholders, but they no longer have special privileges around their stock. This is a really good thing to get commitment from everyone. The last thing is you'll probably be asked in a VC round to put your own equity on vesting. That may feel strange as a founder, but it's actually overall a very good thing. It keeps your incentives aligned to those of your investors, but it also means in the scenario that was discussed beforehand where you might have issues between co-founders, that everyone's actually vesting against a cliff and against the vesting schedule, and therefore committed to stay on board, as opposed to a ghost co-founder who might have, you know, a third or 20% of the company but has left. Governance, I'll go through a lot more quickly, but it's essentially the idea that you set up ways together to go through the good and the bad of the company as you scale it. Number of things here. One is board members. If you take money from a venture capital investor, especially your lead investor, so the person who prices the round and puts in the biggest ticket, it's quite normal that they will want board representation. And if you select investors that are good for you, that you want to work with, this should be a positive thing because it means you get someone that's more available to you and batting on your team with you. The only thing to say here is if they want something called a non-executive director, either instead of the VC or as an additional member on the board, make sure that it's a truly independent person who is also aligned with your goals as a founder. The second thing is, what power do you give the board? I think by and large, the main thing here is, you know, there's various forms and you can read them here, but try to keep the roles very well separated. You have a role as a founder to build a company. Your investor has a role to help you advise on larger decisions and make sometimes difficult decisions. Don't make them responsible for every single thing. It's also really impractical if you need to get a signature from your board member for every hire you make. Drag and tag, you'll see a lot around this, but generally it's about who gets to decide when you want to sell. Drag will generally tend to mean that if you have, let's say, you know, 2/3 or 3/4 of your investors that want to sell, yourself included, you can go ahead and ignore those 25%. Tag is similarly kind of around minority shareholders having the right to sell at a certain price. Again, this is relatively standard. I think the most important thing here is to make sure as a founder that you can never necessarily be forced into a sale, which you could both do through kind of share classes and through rights. The last thing in terms of how you negotiate a term sheet, it's so much easier to
maybe
negotiate.
Sebastian.
Yes, I've got one more.
Sorry to interrupt you on that. Yeah, because I see that Baris is waiting. So if we can wrap up after this, then Baris can also start.
I've got this in the next, so it'll be like 45 seconds.
Wonderful.
This is pretty simple. When you want to go out, make sure you have multiple offers on the table, which kind of comes back to timing your round, how you engage investors, how you communicate your expectations. And then the overall advice, I'll sort of kind of let you read this, but I think the most important thing here is, as you look through the various parts of a term sheet, try to make sure you focus on the key things for you, which I think should be control and governance more than necessarily just high-level valuation. Try not to be boxed by anyone, which means hammer out most of the deal terms before you sign a term sheet, and don't keep an extremely long exclusivity or no shop window, because that reduces your option to go out and get a better option if you want to. And when you talk about difficult things, like what we talked about before, liquidation preferences, it's usually helpful to just put this through scenarios. It's usually helpful to say, okay, so you're trying to cover your downside in case we have a round that's less good. What's important? What is important in terms of how much you want to cover? My biggest advice here in general is try to get whatever stage you're at, people you know who invest one stage later, two stages later, because they don't have an interest in that particular round, but they know what companies look like when they come and get investment from them. And so if you get a seed round and you get someone who's a Series A investor to give you input, they can give you legitimately helpful input on what is acceptable and what is not. That's roughly it. Thank you very much.
Wonderful. Thank you so much, Sebastian. It was, I think, very important and nice information for all of the viewers here. So thanks a lot. And then we will go over to Paris. Thanks a lot for joining because it's quite early for you, I imagine. Thank you so much. And if you want to share your screen or share some slides, feel free. If you don't and just want to speak out like this, also perfect. Stage is yours.
Yeah, thanks for having me. And I didn't want to interrupt. Sebastian had a fantastic slide deck there and a lot of interesting information about the intricacies of deal making. And I missed the earlier part, but it was very comprehensive. I don't have a deck, so and I'm happy to cover whatever you may like, and I maybe start with an intro. And happy to talk about the fundraising environment in the US and how we do deals here. And then if there's Q&A, happy to answer any questions. So we are a early stage fund in the Bay Area. We $180 million. We are actually connected to Europe. We have single investor in our fund, and that's German insurance company and asset manager Allianz. And our focus has been started in 2018, and our focus has been enterprise, healthcare, IT, and deep tech companies, startups, starting as early as founders with a deck to your typical Series A. So we do anything in there. What is called today pre-seed, which is like literally two founders with nothing. Just a deck and a vision, to typical seed stage where you have the product and all, and about to go after the product market fit. And we do Series A, which is once you find the PMF, building and scaling the go-to-market channels and revenue. And we do anything in there. So we've done 18 deals, almost evenly distributed in terms of stages, pre-seed, seed, and A, and dominantly in enterprise and healthcare IT. And we have few deep tech meaning it's a very generic term, but we define it as automation in various industries, starting from manufacturing, space, transportation, and very like agriculture. So we have one satellite company for forecasting weather with a specific set of proprietary data through using radio occultation, try to understand the GPS refractions from the atmosphere and understand the density of or the characteristic of the atmosphere to do weather forecasting, and an autonomous trucking company on the deep tech side. What else can I tell about our fund? All of us are in the Bay Area, but we do invest outside of US, and we have a couple deals in Europe. One in Denmark was a seed stage deal. We invested in the company as they were looking for their product market fit, but they had they have a early version of the product in place when we invested. We had one seed and an A in London. A mortgage automation company, mortgage process automation company, and IoT for home devices company in London. Jel, I guess, do you want me to talk about a bit more the valuation and like how we process the deals here in the Bear, at least in our forum? I'm sure Sebastian does exactly the same thing, but.
Well, so that's indeed an interesting angle. So for example, you're talking about the investments out of the US. So for example, with the Danish company, where there are some things during the negotiations that you would assume as typically European and are maybe not so common in the US or vice versa?
Yeah, I mean, for us, especially after COVID pandemic, it's the remote investments become almost as attractive as right around zip code. The reason we were a bit cautious doing deals outside of our zip code, I mean, zip code meaning like just around our region, is early stage deals, especially pre-seed, and also seed to a certain extent these days, are the formational years of the company. That's where you really do have more hands-on help. So when we invest, we do take board seats. Sometimes it's a board observer, but we do get, really lean in and help the company in whatever it's needed. That could be under, crafting the go-to-market strategy. That might be hiring in specific areas, could be, hunting for a CTO or a go-to-market person, either a VP of product marketing or a VP of sales. So that kind of requires you to be a bit more closer. But with COVID now, look around, I don't know, probably a lot of people dial from all kinds of cities. It becomes less important. And so that's why we get a bit more, flexible in terms of the locations we invested. We now have investments all around the US, LA, Denver, Pittsburgh, Oregon, and different countries, India, Denmark, London, Canada. So with Europe, definitely we are way more comfortable in terms of investing in early. Obviously, the time difference makes some challenge, but with video and a more, direct channel to the founders, it becomes less important. So what we look for, especially on the pre-seed, and maybe I can define that a little bit clearer for you guys, the pre-seed, seed, and A. With the pre-seed deals, majority of our deals there, if not all, are all repeat entrepreneurs. So our thinking is, yes, we do take risk, but we want to take a calculated risk, and we want to go after companies, founders who have done before. So he or she might have be at another startup at an executive level, C level, and when that company went to an exit, or have started that company and went through an exit. An exit doesn't supposed to be a huge exit, right? It could be in another form. I mean, in certain ways, failure is a huge opportunity to learn, and we have done that before. Like we have a company where we invested, the prior company of the founder didn't work out. But the key thing with the repeat entrepreneur, especially at pre-seed, is someone who really went through a lot of these things before. Because startup is a bit different, right? You at a bigger company, an executive joining in startup, they're going to learn a lot of stuff for the first time. I mean, starting with hiring, no one is jumping to join your startup, right? So you need to really attract key talent, and a key talent is really hard to attract, especially these days. So with the pre-seed, we go after company founders who have done this before, but we take the risk of everything, like product team build up, product build up, market execution. We take all those risks. Because we trust the founder. It all depends on the founding team. We trust the founding team to be able to execute there. And yeah, we've done one number of those deals, and like 2 founders, 4 founders, 3 founders. That we haven't done a single founder yet, but majority of them are founding teams. And literally it was only a slide deck, nothing else. One of them was not even formed when we decided to invest. So we are very comfortable there. And I'm not alone. A lot of our colleagues in the Valley, they do that. And just to give maybe a side example, without naming the company, I mean, I lost multiple deals going after founding teams who are acquired into larger organizations, and they accepted the term sheets while they were there. They haven't even quit their jobs. So it is that competitive for that kind of talent. So you need to go after them even before they took the steps to leave the companies. And then we do seed deals, and seed deals is fairly typical now. You have the founding team, you have the core engineering team in place. You don't have a go-to-market. It's usually founder-led sales. There's one or two design partners, like close customers who are helping you to form the idea, to form the product, in giving you feedback. But there is usually no revenue or very little revenue. And little revenue might be coming from the paid pilots or very little consumption of the product. That's where you kind of take the risk as an investor, and to go find that PMF, the product market fit together. And there's a lot of, you need to kiss a lot of frogs along the way. And that's kind of like we've been doing with multiple of our companies, trying to understand which segment to focus and within a bigger market, and what type of customers, like what is the ideal customer profile. That whole exercise, I actually find it very exciting to work with founders on it. It's frustrating sometimes, but we do like that stage. Again, strong teams, it could be a first-time team, and we've done multiple first-time founding teams there. And Series A is also a very typical, you have an X number of dollars as a revenue, you have the team in place, some form of go-to-market motion is in place. That could be still founder-led, or that might be some account executive there, or SDR, sales development representative there, and getting some early revenue. And I think that's also one critical threshold that a lot of people talk about. Depending on the risk profile of the market and investors, some people may require, hey, I need 1 million ARR before doing the Series A, or sometimes higher. But what I've been seeing, at least in the last 18 months, 24 months, that is fairly lowered. I see a number of Series A deals done less than $500,000 revenues. And again, what makes the difference? We can talk about it if it's interested, but the risk profile of the investor is changed enough to give credit for the future revenues, or for the belief that the founding team is going to be able to get to those numbers. And obviously that's driven by the market dynamics in terms of the ability to close those sales deals, but also the investment dynamics, which is the competition. So like I may not take the risk, but Sebastian may say, hey, I'm going to take that risk. So suddenly that deal that risk is takeable. So Gel comes in and put another term sheet. So it's kind of like this whole competitive dynamics form. I think Sebastian mentioned briefly, having multiple term sheets is key for a lot of the leverage with the investors. I mean, it kind of changes the whole dynamic in terms of the prices, the amount of raise, or the terms. So I'm sure he can agree with that too. Yeah. So that's the stages, or the maybe the parameters that we look at. I mean, I can talk about maybe also a couple of things that I see, and at least as a difference. I took 3 bullets yesterday when you wrote me the differences between US and Europe. I can't really just compare it with Europe, because I'm not as familiar anymore. I used to invest like 5 years ago in Europe, like as a person on the ground, but now I'm in here, it's a bit different. And also Europe has changed a lot. I see deals, I mean, we got kicked out of deals in Europe because it got so competitive. Doing it all the way from here is obviously a problem, because we don't have the relationship, but it is getting more competitive. So I will assume a lot of things change in Europe. But overall, I mean, what we care, I look at like what we care when I see a deal from Europe is, and like as an advice to, if I, for example, invest in a pre-seed founder or something, and they are going for their next round, my number one advice will be really focusing on the story, that vision. And that's where I see usually lag with European founders and decks. or pitches. The story sounds a little bit vague, but it makes the whole difference, at least for us. I mean, it's probably one of the most important points. I mean, I think Vinod Khosla has this famous saying, and I think he describes this situation the best. He says there's a huge difference between a $0 million startup and a $0 billion startup. And there's no difference in the business plan. It's just the attitude, right? They're both zero. But just to maybe give you an example of this from few companies that I dealt recently. I'm looking into the finance organization. I'm trying to find investments in that CFO stack. Basically, CFOs haven't innovated their software stack from like monthly closures to forecasting to treasury activities to all kinds of stuff, payroll and all that stuff. I see a lot of companies there, and I say, I mean, I can just bucket them too. Like the ones with very tactical, hey, we do monthly closures, we collect all the revenue data, we look at the expenses, and then we close. And that's the pitch. And that sounds interesting, but it's a tiny market. Then there is another type of founders, and they come and say, this is where we start. This is what we do, monthly closure. We collect all the data, we provide and build a foundational data platform. And that data platform in the future will let us to build monthly closure to cost management, to financial planning and analysis, and then eventually we're going to replace the multi-billion-dollar NetSuite. So that vision is what is compelling, because that's all you have when you're early. That you need to be able to execute to something towards something else that is bigger than just a specific SaaS workflow automation. That's not going to excite many of the investors just because the amount of risk is involved with these companies. So that's where I see a huge lag between, I mean, it's hard to generalize this because there are also fantastic entrepreneurs and founders in Europe. But that's where I see more common, I should say, the lack of this big vision, big story, where they have almost a blueprint in their mind. This is where I start. I built my Trojan horse, leverage points, and then as I grow, I build a big vision. And the second one, I guess, is the amount they raise. And there's some cautious behavior that I noticed, like, you know, raising X dollar, which is almost half of what a lot of the US investors, US founders go for. While I understand that there might be less options in Europe in certain from an investor perspective, just because US market is bigger. But once you're raising, when you're in the game, you're in the game. Right, it's a Champions League, whatever you would call it, is the Champions League. So you can't just go with less revenue. You can't do that. Like, it's just not going to work because, less capital raised, because you need to go execute towards the same goal, and you compete with these other folks raising in New York. You can use the cost arbitrage, like low cost engineering and all that stuff, to a certain extent, but at the end, you are going for a bigger vision. That first thing I mentioned, the bigger vision, and you need to execute towards that. That means whatever the raise amount, you need to go after and then be able to show a planned milestones and operating plan behind it. And third is more tactical, and that's more a good, well-designed deck. It doesn't mean it's just a lot of cosmetics, but just well-designed in terms of the thought process. I think that's also very helpful in terms of getting the attention. But number one, I'll see a lot of my colleagues, the story will grab you. And I mean, the founding team obviously is very important if you call that step zero. But step one, then it will be the story. What is the story of this founding team? Sometimes even the first time founders will have fascinating vision. And that will kind of be very compelling for us to take risks at many earlier stages. That's I guess one of like the 3 points that I saw in terms of the differences between the European and the US early stage pitches.
Indeed, very interesting, Bryce, because those are indeed all topics which we talk about here, but there are indeed some differences geographically seen. Even in Asia, there will be even different than the
Yeah.
ones we know here in Europe and that they are in the US.
Yeah, I mean, I think one of the things if you look at the, like, also this drives everything, right? That vision and being able to go after something big and kind of it drives your race. And then that drives your valuation. I mean, what is valuation, especially at early stage? You don't have multiples to, like, you don't have a lot of data points to be able to price a pre-seed or a seed deal. There are, I mean, these days, like, the numbers are, just to give you a sense, I mean, on the pre-seed, meaning literally 2 founders or 3 founders, it's like they're raising usually something up to $2.5 million on, 8 to 10 million pre. And on the seeds you raise these days, 3 million to almost 10 million, but let's say 3 to 8 is the norm. And that's usually around, like, 10 to 20 million pre-range. And on the A, like, you raise more than 10, 15, and that's, anywhere from 30 to 100 million, or even more sometimes. So, but that, those numbers are, like, especially on the pre-seed and seed, is not easy to justify by any numbers. You can't use your revenue multiples or whatever, which is it's a kind of a proxy for a lot of things in the venture. But then the other angle or pillar of valuation is, like, some of the comparables in the market, which is what I just described. Those are companies in your stage, in your area, what did they raise, regardless of their revenue. So that kind of gives some ballpark. And the third is how much you're raising. That defines the valuation, because that, like, for that raise, I'm going to get X%. That's my requirement. That X%, let's say, if it's, if I get 15% of the company and you want to raise 3, so that kind of like tells me your 18 post, so 15 pre, right? If you raise 1, it gives me a different message, and you get a different valuation. So I'm not saying, but that's another data point. I'm not saying that you need to raise more to increase your valuation or something like that, because the second point of that I made was you need to have a plan, an operating plan to back that raise. So if that operating plan makes sense for the investor, yeah, you're raising $3-4 million, and with that, you're going to go after a specific vision that is very compelling, and that $3-4 million, I'm going to take 15%. So that means that your valuation is set, basically. Like, that raise amount defined your valuation. You can negotiate on the percentage you want to give it to the investors, but it's going to be minor, because a lot of these investors have their minimums. So you get into a ballpark immediately just with the amount of raise you define to raise. And also the raise give another signal, which is how difficult is it to do this thing, right? If you are raising a smaller amount, it signals that, maybe this is not a big opportunity. Maybe just anyone with $1 million can do this, or anyone with $2 million can do this. Maybe that's not very important problem. So because just the amount of things you need to do early on is just too costly, that you expect some form of capital spending, then that goes back to the operating plan. Is there anything else I can cover, or sorry, I wasn't, I guess, super prepared with the deck.
No, it was perfect. Also, timing wise, I think we can end here. There were some other questions in the chat, but mainly pointing out to Ruben. So Ruben, I would assume, because we otherwise you run out of time, to answer them privately. And then I think, Baris, it was a wonderful addition to the things that we discussed already with the previous speaker. So thanks a lot for that. Thanks a lot to all the viewers as well to watch the webinar here. And if there are any questions, feel free to reach out to or Ruben or me via mail, via LinkedIn, or you can book a free expert session here via the QR code. And then nothing else to say then. Thank you so much, everyone, for joining. Thank you so much, Baris, for your insights.
Thank you. Thank you for having me.
There we go. All right. Thank you so much, everyone, and
Bye.
have a great evening.
Good guys.
Bye.
Thanks.
Bye.